Hey guys, Bob and Phil here, another Trade Genius podcast. Glad you could join us. In this video, we're going to show you something that normally only our newsletter subscribers see, and we're going to show you a liquidity signal that we think you guys should see. We're going to let you in on that little secret, and be careful because what's going to happen over the next coming days and weeks could be very detrimental for this market. So you're not going to want to miss this episode. Let's dive in.
Trade Junior.
Hey Phil, I'm really glad we're going to talk about this today. This is really interesting information and this tool that you created is absolutely awesome because a lot of people think the market is like this woo-woo, mysterious. Why is this happening? I can't believe, the market's rigged, and it goes down and there's visible forces at work here, but they're only kind of like half right. The forces are invisible, but we know where they are. It's just like knowing you got a stealth bomber up there, but if you have low frequency radar, you can see the stealth bomber,
right.
and we know the moving parts, and it gives you an absolute edge in the market. And what I want to do is, if maybe before you get in and talking about it like in general, could you maybe break the components down of really what this tool is and does? And why it's so important to be on the right side of it.
Yeah, so, the idea of Fed liquidity isn't something I came up with. I mean, it's a known concept out there in the market. But essentially what we did at Trade Genius is we packaged it together so it was just kind of like, you can see if it's going up or down. But it's really a component of the Fed balance sheet, a component of the Treasury checking account, essentially is what we call it. And also the reverse repo, which is where the banks go overnight to park their money because they can guarantee make money at the Fed window. Okay, so it depends on what level all three of those things are at, and what they're doing is the balance sheet going down and the other two going up and vice versa. So it fluctuates. But at the end of the day, that calculation gives us a net of what the liquidity is in the system. And in our current modern Fed-driven markets, this matters a whole bunch. In fact, I'll tell you, it's probably the only thing that matters. And it really started to become an issue when COVID, when they threw all this money in to the system and this liquidity and gave everybody money. It just, they panicked. And now they're bringing all of that out of the system. And we'll show you the charts, and we'll kind of show you a big picture too of where we've come from in terms of liquidity. But in a nutshell, that's what it is. It's those three components, and they literally drive the stock market up and down.
Yeah, one of the really interesting that I noticed about this, Phil, is that, and we're teasing you guys a little bit here, we're not stalling for time, but one of the things that I've really noticed is that when this liquidity thing turns on, the market reacts really fast to it. But when the liquidity turns off, it's almost like, you're a truck going down a hill and it takes a while for like the brakes to hit because the market naturally wants to go higher. Right. I think that is the natural order of a market, is that people want it to go higher until they see something and they get fearful, and then you see the big drop.
Right.
And I noticed that here too, because recall, and guys are probably listening to this, a lot of new people probably listening to the show. But we've been talking about this liquidity thing ever since we got into the top in October of last year, and then we had a big bottoming in April. Is that whenever we see this topping action again, people don't want to believe it. And there's usually like a 3 or 4 day delay on that.
Right. And
I think we're very fortunate, I think, because it gives you a chance to pull out of positions.
Mm-hmm.
And I think if you look at it here, and I'll let Phil hop in there and show you the chart itself, but look at the lag on the risk off, and then you need to go ahead and just really be thankful that you have that option. And the risk on is okay. You miss it by a day. Usually you get a couple weeks move, but these risk off move, once they hit, it drops really fast. And we even know where the targets are, which is really wild. So maybe, Phil, after that, you can kind of explain what fair value is and also, where that line is where we think you'll start seeing support again.
Okay, yeah. So the Fed liquidity that we like to call it is this blue area, the shaded area. You can kind of think of that as the fuel in the market. So you can see as it starts to trail down, right, the market comes down, all right? And so this This Fed liquidity moves on its own. It's not, oh, the market's going down, the Fed liquidity drops. No, the Fed liquidity controls the market. The market follows Fed liquidity. So and what we've done, because, when you look at that, it's a little jaggedy. It's hard, you have to kind of look at it at the average of it. So that's what we did. We looked at the average of it and threw some math at it, and basically then was able to tell us the prime spots when we should consider the market risk off, and then when we should consider the market's risk on. And you can see broadly that it works really well. And basically, we just want to trade in the direction of that. And so if we zoom out, you guys can see, especially since the top of this market, going back to 2022, you can see what's happened with the liquidity, right? Just keeps going down and down and down. And this market will not go back up unless the Fed stops being tight with their policy and starts to ease. And there's another misconception about that too. Everybody's clamoring for a pivot. In reality, and if you've watched our videos, you know our stance on that. A pivot is actually when probably the final part of this bear market plays out. But eventually that will cause this to go back up, and eventually the market will follow it. So where we like to key in on these risk on, risk off signals is the fair value. So what we did is we just applied a measurement of, where is price typically when the liquidity is printing a certain amount, and we came up with what fair value would be for the market at any given time based on where liquidity is printing. So as you can see now, we're up here. We've already hit the short hedge level. If we get a little higher, we get to what we call the euphoria, and you essentially just get out of the market at that point, because you can see how that works. Here we hit it over here. You can see that was the top of our last bear market rally, all the way down to the bottom, and then we finally got a risk on again there. Here was another point where we hit euphoria, and you can see sharp drop after that. All right, so very, very important levels. And whether or not we hit that, maybe if we do get more of a push up here into, because you got to keep in mind Wednesday is the big day, right? That's the FOMC rate decision. We're all expecting 50 basis points, or they could keep it hovering around here. But if liquidity keeps pulling back, that's going to force the fair value of the market higher. And so if we do get that euphoric print, get out of Dodge. And this is on a daily chart. We use this on a daily chart, but on a weekly chart too, this has been risk off since the very top of the market. And we can show you what that looks like.
Yeah, and while you're doing that, Phil, it's really interesting is that because a lot of people are calling for we're going back into another bull market, and you and I are just sitting back there and laughing. We're like, ain't no way.
No.
Because if you combine the Fed liquidity chart with the inverted yield curve, those are two pieces of information that tell you the mother's milk of the Fed is she's telling you you're going to go hungry. and so people got to be really, really careful here. Now, people know us for a long time. We're not doom and gloomers. You make more of your money when the market's going higher. So, so we're not advocating market crashes, but you have to recognize them, because you want to be light when this market's rolling over. And to the extent that you can short some things, we can share some of those ideas, and I have one for you today, to position yourself for a market selling off. And then you're positioned then in a much better frame of mind when you get that risk on signal. Because what happens to a lot of people in trading, the psychology of this, Phil, is that when people get burned enough times, when they see the light at the end of the tunnel and it is truly sunlight, they think another train's coming, and they're afraid to take the trade, and they miss out on these great opportunities. But if you got dry powder and you kind of sidestep some of these moves, and which we've had all year, is that you're in a position to be aggressive going into the market going higher. And for us, looking at that weekly chart for Fed liquidity, you shouldn't be pushing your chips in until you start getting a long-term buy in liquidity. And it will come. The Federal Reserve and the Treasury and the powers that be aren't suicidal. At some point, they have to relent. They're just more afraid of inflation right now than they are about a recession. And when that fear flips, then you're going to see liquidity pouring back into the market again. And the other thing, too, at least the theory is I hold, is the Fed hasn't really been fighting inflation this whole time. I think the Fed has been fighting a weak dollar because they're fearful of what's going on with Russia and China, and they're trying to drive commodity prices down, basically try to bankrupt Russia. At the same time, damage currencies that are competitive to them, like this new notion of a BRICS kind of, new kind of a currency pair. I think they're trying to kill that stuff in the crib. So that's the other thing you keep in mind. Even if the PPI is soft and the CPI starts getting soft, the Fed's not in a position to relent at this point because they're not getting unemployment and they're still getting economic activity. And I think people are totally misunderstanding what they're trying to do here. So we use these tools to take our bias out of here. And in our trading room, we go back and forth with each other on this stuff because it's important to know that you don't control the movement, right? You're just a participant on the ride. And I'll throw it back to you, Phil, for some final thoughts on that.
No, totally agree. So, yeah, this is just the big picture, but you can see we're risk off. I'm right near the top of the market. And if you're managing a portfolio or a 401k, that's telling you, hey, you probably should get to cash. And you really don't have a signal on the weekly to go back into the market yet. But there's a lot of opportunity on these wiggles in between, and that's why we like to look at the daily. But want to zoom out on the weekly, because if you zoom way the heck out, to kind of ignore the diamonds there for the time being, just focus on the blue. You can see where here's COVID. Okay, COVID happens, they panic and they hit the printer hard. That's blue, and that's why the market did what was seemingly impossible and just skyrocketed. It wasn't anything organic. This was basically the Fed fueling the market and the banks taking that money and having the mother of all pumps. Now, the Fed says, hey, we're going to get rid of all the inflation. We're going to get rid of that pressure. Look how far down they got to come to get back to where we were prior. You can see prior to COVID, this market actually, although there was volatility, you could actually see the market was maintaining an upward rise and they were taking liquidity out, right? They were trying to roll off their balance sheet essentially, and this is part of that. The balance sheet's part of this equation. So you can see we got a long ways to come back down to get rid of all of this pump that they put into the system. And whether they can get us all the way back down there without creating chaos and mayhem and having to, go back to cutting rates really quick because things are starting to fall apart, I don't know, but expect them to keep trying because, the balance sheet that the Fed has is way too high than what they like to see it at. And primarily the central banks love to be in an environment where they can have 5, 6, 7% interest rates. Because it gives them two things. One, that's the business they're in. Two, if things hit the fan, they have clips in the gun to fight whatever troubles are going on in the market by cutting rates. So they don't like to be at 1 or 0% rates. That's not the ideal environment. So they're going to continue. That's why they've been very stern on their language about how they're going to continue to be hawkish going into 2023, 2024. But make no mistake, if things get dicey, they're going to cut. They're going to pause. They're going to pivot. They're going to cut. And it'll come. But it won't be bullish for us, at least on the onset. But once we get our signal risk back on, boom, you can start redeploying your cash in those long-term portfolios. But this gives you a very, and this goes back to even 2008, right? This is where, boom, you had the big jump up from the great financial crisis, and then all of a sudden it's just a new era where it was just a Fed-driven market and this liquidity. So you can see this isn't going away. We've been doing this for a decade. It's not going away, but some of this extremism that we've seen in the last couple of years definitely will be taken out of the system. So it's very important to understand that this is the way the markets work now. And that's why, like Bob said, sometimes the market moves don't make sense. Like, did anybody think we were going to pump to all-time highs and beyond during COVID? No, the economy was shut down, but it didn't matter because this overrides reality. And so that's the key point we want to show you guys. But yeah, back to the daily. So that what's really briefly, we'll go over this one more time and I'll show you one other thing that's going to show you why it's going to be very tricky here. If you're trying to get long this market, probably not a good idea. When we get these short hedge marks with our fair value and you get risk off, that's the combo you want to watch out for. So you can see that combo happen here, and you can see that combo happened over here. Let's see, risk off. We didn't quite get there. We're close though. But when you get that risk off and you're up in that area with fair value, you want to be very, very careful. We did not get risk off until here on that run up into August. So, even though we had those prints up there, we're looking for that combo, and you can see it can run a little bit too. But once we get the risk off and that mark over there at hedging and shorting level, you want to get out of there. And the same thing happened here. We had hit that level here, and we got risk off, and then boom. So you can see that combo is very bearish, and that's what we're up against here. And depending on what the new print is, we may see this shoot up into tomorrow again, which would be very bearish, especially with that risk off. So yeah, Bob.
Yeah, no, I was just nodding in agreement. I said, yeah, and just so people know, when you get these combo packages, you could invest $2,000 or $3,000 into a SPY put trade and probably make 10x your money. Okay, we always talk about you don't need to invest a lot to make a lot if you're on the right side of the trade, and so in this situation here is that I actually put a trade out for 2 weeks, even in a position where today, we're doing this. We do these videos the day before the market is. The PPI will already be out. Even if the market's up today, it doesn't really matter to us because we know on average 5 days out, you better get short the market because liquidity is not coming back in, and you just can position yourself. You invest a couple $1,000, you can make 8 or 10 times your money over a 4 to 6 week period of time. For those who have a steady hand at this stuff. I'm not advocating you take leverage risk. But my point is that the moves are that big when you get that double signature there on the. And the other thing we're seeing too is we're seeing the bond market creeping up, which is telling you big money is moving into bonds and out of stocks. And the final point I'm going to make on this before you jump into the 40-day cycle, which is another confirmation signal, is that with interest rates so high and the housing market basically stalled in terms of sales, people are staying in their homes longer. And there's what's called a convexity trade with real estate, and mortgages that, they're always eyeing out like a 7-year, turnover. When you buy a 30-year mortgage, you're really buying a 7-year mortgage. People don't realize that because people are rolling their mortgages every 7 years. So they never feel they have to have a mortgage that's farther out. Well, people not moving, that average maturity now is going to push out in time, which means you're not going to see mortgage rates falling anytime soon. People are going to stay in their houses longer. But the amortization schedule is actually going to work against the Fed liquidity because they bought mortgage-backed securities. Those securities are starting to dry up. They're not being replaced. Again, another piece of credit that's not coming into the market. And going into next year, we're going to have credit card debt that people can't service or people can't qualify for because we're up to 30% now, in terms of average, credit card rates, is that's being cut off. Auto loans are being cut off because they're too expensive. All that stuff kind of works against the Fed trying to reignite. And with Congress being split, you're going to have trouble with fiscal stimulus too. So it makes for 2023 to not be the year of the turn until maybe things get pretty bad. So I want to finish with that, Phil. I know you want to jump in this 40-day thing. It's really another interesting concept that people aren't aware of.
Yeah. And again, we cover this in the newsletter. You can go to tradegenius.co/newsletter and sign up there. And basically you're going to get a playbook all through the week on, the next session, and what to do and what levels to watch out for. But we update these charts constantly in that newsletter. And this is a 40-day cycle. What you'll notice or you may not notice, but in bear markets, they tend to get very cyclical, especially when they're being walked down. And in our situation here, we've entered into a 40-day cycle. So essentially, we're alternating between going down and going up. And so we're just completing the up cycle, the 40-day up cycle. We're just getting into that. Now, generally, you want to be positioned bearish as we get into the negative part of the cycle. Can we push up into it? Yeah, we can push up into it. That happened a little bit here. We held, and then we finally started to drop. But if you're playing for 40 days out, generally if you're getting bearish in here, you're typically expecting this thing to roll back over. Now, every single one of these bearish 40-day cycles has resulted in a new low, and in some cases quite a bit lower. So again, another reason why you don't really want to get super bullish here, unless the confirmation to get bullish would be seeing an excess amount of liquidity coming back in. And we just don't see that right now. We just got a risk off signal. We're just entering now the end of this 40-day cycle. And down here, this next indicator lower, this is the gold correlation line. And every time we get up into this overbought area with gold correlation, it tends to, you get a pretty steep pullback eventually after that. Here we got into it, pulls back. Here we got into it, and we came up, and then we rolled over really hard. This is just an area that we keep an eye on where the market seems to struggle once this is up there until it finally comes off, and then the market tends to take back off again. So here we are again hovering at this area. So we should see some sort of pronounced move back down. Now, again, I'm not going to say this can't go up. It certainly could push up a little bit more here, but usually when we get to this point in the 40-day cycle, all bets are off. Eventually, you're going to get paid on that bearish bet as it rolls back over. And the only caveat to that would be as if liquidity comes roaring back in. And if you get the newsletter, you'll know how that looks every day. So anyway, we thought we'd share that with you guys because we felt there was enough things lining up here that if you're thinking about getting back into this market, you might want to think twice and be careful here, because the chances are we're probably going to roll back over. This bear market is not over, and the liquidity is basically the master of all that, and it's going south. So, and then Bob, you wanted to look at a chart of the UDAO, right?
Yeah, that's correct, Phil. We, people always ask me, okay, Bob, that's great. You're giving us all this good information. How can we make money from it? I want to throw a freebie out at people here that can trade options. If you can't trade options, just think SDOW, SDOW, and you can buy shares of it. But you make more money when you can short these leverage ETFs with puts. So that's my go-to on this. So Phil is showing you the 40-day. Phil is showing you the liquidity chart. But we have another indicator that we use too if you trade with us. And part of that is the we have a heat indicator, and it tells you when it's time to kind of roll over in terms of selling or time to buy. If you look at the bottom here, this is the indicator that's actually going to be available for people for sale at the beginning of the year, but we kind of bake it into our basic and advanced indicators in terms of buy and sell signals. But here, if you notice, I brought it up and showed you the indicator here. Every time that indicator, we call it the heat, gets overbought, where you see that, I guess you can call it magenta, you can see it rolls over. And a lot of this stuff ties in with the liquidity charts too, because this is the Dow 3X. And so if you notice the last two times, the last three times I throw the arrows up at you here, whenever that goes magenta overbought, you should position for puts at the money, and these are monthly, so you want to go out at least 4 weeks on your trade, but not get greedy. And the last time I just showed people and put the trade out there for the subscribers, Phil, it was trading at $64. We bought the 60 strike puts, and we made really good money. We rolled that trade up, we closed it, because guess what happened? That went from being magenta to that teal color. Don't overstay your welcome, take your profit. And now we're reloading back up. You see that box rectangle on the bottom right is that when that gets magenta again and rolls over, I told people start positioning. I put a rectangle up there, probably where I think the price is going to be. And those other lines that you see on our charts is we have what's called moving volume weighted average price. You see our trend bands. These are all tools that we use to help people be on the right side of the trade. So quick plug, if you want to trade with us, go to tradelikeagenius.com. We got some Christmas specials run. You can take advantage of it. You get the range trader, you get the trend band, you get the moving VWAP, and you're going to be on the right side of these trades. But these triple trades, when they get overbought, are just a thing of beauty, especially when they line up to Fed liquidity turning off. It's almost like free money, and I want to share that with you guys. So today, if the market is getting soft because of that, and you're watching this thing before Friday close, you have an opportunity to probably to get into UDAO. If not, take a look on Monday. But you're going to be rewarded when that thing gets overbought. And if you don't want to do all that thinking, you can just join us and we'll throw that trade out there and we throw it in the room for our subscribers. So I just wanted to share that with you guys.
Yeah, awesome. Thanks, Bob, for that chart. The last few stock picks you've been sharing have been real bangers, so hopefully you guys can take advantage of that. And once in a while, we have our stock pick videos, so be sure to tune into those stock pick videos. Bob picks out the best ones for you guys. So anyway, that's going to do it for our video. Thanks so much for watching. Please hit like and subscribe. It really helps us out. Again, if you want to see the newsletter, head over to tradegenius.co/newsletter. You can sign up there and it'll have all of the regularly updated information on those charts and things that we showed you today. And I think you'll find it very beneficial, especially if you're an active investor in the market. Until next time, guys, see you later.
Trade Genius.